Welcome to the Economic Countdown. Please remember to like, share, and subscribe. The world is going all in on what everyone scoffed at just a couple of years ago. Over $15 trillion in government debt went into negative yields. The milestone is pressuring investors seeking yield, such as pension funds, into riskier assets in hopes of delivering any significant return on capital. It's believable the dollar will one day weaken in a very significant way, and that the weakness will contribute to and accelerate the rise in the price of gold. But the dollar weakness will not be the catalyst for that rise. The catalyst will be the outflows from portfolio managers, pension funds, and insurers who will be forced to seek alternative investments. According to Citi calculations, the U.S. now accounts for almost 60% of all positive yielding debt and 89% of the positive yielding debt which has a tenor of less than a year. U.S. debt accounts for 74% of the positive yielding G10 debt in the 1 to 5 year sector. The result is clear as day to anybody paying any attention. If the Fed hikes interest, U.S. paper becomes more attractive. Capital inflows to the U.S. increase, and a higher dollar is the result. This also means that equities, particularly dividend-paying equities with solid balance sheets, will command a premium. This is one of the reasons that we'll continue to see the highs in the Dow and the S&P, and why there should be expected pressure in the gold price. And while the Fed continues to insist that rate hikes are data dependent, the Fed also gets to decide what data to pay attention to. Let's be clear. The Fed does not have much room to raise, yet will have to raise to maintain some credibility. The Dow, gold, and rates can all rise at the same time under the right conditions. In the mid-2000s, the Fed raised the federal funds rate from 1% to 5%. During that time, gold went from $400 to $700 an ounce. We're now seeing pressure on both sides. If the Fed raises rates, gold will go up. If the Fed doesn't raise rates, the risk to the US dollar and the value of our debt becomes more questionable, and gold will go up. The market reaction will not be kind, and in the short term, it'll pressure metals. The buying opportunity will be phenomenal once knee-jerk trades are done. In the words of Janus Global Fund Manager Bill Gross, capitalism can't survive negative interest rates. When the Fed is forced to reverse that policy, it will become clear to everybody that the age of the central bank control is over, and those positioned in the right venues will do very, very well. The faith is slowly but surely coming to an end as the results fall short of the promises and expectations. We need to understand that the big money, the portfolio managers, pension funds, and insurers, cannot continue to invest exclusively in negative yielding assets. Understand that a trickle of the trillions they manage will work its way into the U.S. markets, the dollar, and gold. Not because they're gold bugs, but because they have no choice. Understand that of those three options, the U.S. stock market, the dollar, and gold is the smallest market, most susceptible to the largest moves. Within the gold market, the junior resource market, especially the junior gold companies, has been especially hammered, and it provides the best risk-reward proposition. Luckily, for those who are active in the junior resource space, and specifically the precious metal space, there is a lack of companies doing meaningful work. The lack of companies doing meaningful work makes it much easier to pick the best names, and in part makes it easier to do well. The best gold miners have potential catalysts in the near term that could take them higher. Some will be bought out at hefty premiums by major gold miners, and it's just a matter of when. Here's another warning underscoring the discord of current policies. The warning comes from the chief economist at Deutsche Bank on the European Central Bank. The litany of distortions, perversions, and disincentives grows by the day. Savers are punished and speculators are rewarded. Bad companies survive while good companies are too scared to invest. The criticism will get louder in Europe, Japan, and one day here in the U.S. Thank you for watching the Economic Countdown. Please remember to like, share, comment, and subscribe. God bless America.